My name is Gareth Soloway, and I was a losing trader until I mastered technical analysis. Logic and charts beat hype and narratives every time. Now I teach investors the same techniques that made me a multi-millionaire. This is my trading game plan. Good morning, everybody. Welcome to my trading game plan, where we're going to discuss the reasons for the Fed they have just introduced quantitative easing again. Now, this is shocking to me. It should be shocking to you guys as well. What is the Fed not telling us? What do they see in the data that has them so worried that they have to do a 180 from dumping bonds and selling bonds to now starting to buy short-term treasuries? And again, this is a way for them to inject liquidity into the system. It started back in 2008 with the financial crisis. That is supposed to be when it's used, during a financial crisis. Yet here they are in an apparent okay economy, and they're doing it. In addition, Oracle falling. I thought it would actually rally on earnings. Instead, it collapsed down 14% this morning on the back of earnings. Now, their earnings weren't bad. They did miss revenue by a slight amount. They even announced they had new customers like Nvidia and Meta versus just OpenAI. But the reason investors are panicking is because the debt issue continues. They basically said, we're going to even up our CapEx, which means more debt on Oracle's balance sheet. And that has investors worrying, and it brings up this whole worry about the AI trade and this debt bomb, where all of these players, these hyperscalers, all of them are buying these chips. And really, they're writing them off over 7 years in terms of their value. But in reality, the depreciation on these chips is 2 to 3 years max. So imagine you take out a loan, billions of dollars in loans, and you say, oh, well, don't worry because these chips will be valid in 7 years still. But in essence, they're all the way gone in terms of value in 2 to 3 years or almost. That is an issue in terms of coming back to pay back those loans when you have to buy new chips, the best chips, the newest chips from Nvidia or Broadcom in 2 to 3 years. It's a big issue, folks, and the markets are taking note again. All right. Last night, the S&P futures dumped out sharply. Let's take a look. Look at this. This was yesterday's rally on the Federal Reserve being a little bit more dovish than expected. Now, let's be clear. Jerome Powell did say don't expect any more rate cuts in the foreseeable future, but we all kind of expected that. Plus, he has to kind of hold the line slightly. But I think he gave his tell, right? When you say, oh, we're not going to cut rates, but wait, let's introduce quantitative easing again. That's a huge signal to investors that something is amiss, that they are seeing something in the data behind the scenes that most investors are not aware of. Now, again, last night, look at this drop on the S&P futures collapsing down to the point where if we zoom out on the S&P futures, we made a low that wiped out basically going back to the early December period. All right, if we look back here, folks, this is basically week or over a week lows on the S&P. Now, we did bounce back here this morning. I would dare argue that, again, if you're an institution, do you really want the markets gapping so sharply lower and then trying to unload into retail? Or do you want to push the markets up gently into the open so it's not so scary and retail feels more comfortable buying it? And again, I do think we could actually sell off throughout the course of the day here. But again, you have to understand the game that's being played by institutions as they have billions and billions that they need to unload. They can't just allow the markets to be opening so sharply lower. They got to bring it back up, keep the interested retail investor putting their money in, leveraging their money up, all of those things. All right, let's go on to some other charts here. We look at the bigger time frames on the S&P 500. Here was your day yesterday. We had a nice move up, but it was only, again, 0.68%, not even 0.7% on the back of a much more dovish Fed. And we're essentially seeing a majority of that wiped out today as the markets are starting to recognize that quantitative easing is back, and that's telling us something economy. All right. In addition, obviously, Oracle's playing a role here. Oracle, again, if we flip over to Oracle, I mean, look at this drop on Oracle trading down at $193 per share. Yesterday, again, closing at around 223. Now, yesterday, I did tell you I did hold a position with Smart Money Stocks and ETFs members, and luckily, I unloaded half of it for a good solid gain. I think we banked about $13 to $14 per share on the half that we unloaded. Now we're down about that, but that's essentially net break even. In addition, I can re-enter if it gets down to the levels I'm going to talk about in just 1 minute. All right, let's do it right now. Let's talk about Oracle here. So Oracle, again, getting hammered. We flip over to our daily chart. Here again was our previous low. This is going to be a very good level around $189 on Oracle. You have the former major pivot low, which happened to be gap window. If it does break through, let's just say the stock market sells into year end and we don't get a Santa Claus rally, then there's epic multi-long month support here at gap fill 177. And I want to be clear, folks, what Oracle's going through. So Oracle's still a very profitable company, right? And so, yes, they're taking on a lot of debt, but again, the debt is a concern, but they're still wildly profitable, right? And the key here is the debt bomb I discuss here is more relevant to these other players, these newer entrants that are taking on these big loans that have no profitability yet. Because the idea is if you're profitable, you can pay back. I mean, it may take some time. It may eat into earnings with interest, but ultimately you'll pay your money back if you're making a ton of money like Oracle is. And Oracle makes a lot of money. But again, the fact that they're taking on this much debt, and we see this going through a lot of the other hyperscalers and AI plays that are not profitable, that's where the debt bomb comes into play. So just understand that, because again, a lot of people would say, wait, why, you're talking debt bomb. Why would you be long Oracle or looking to add to Oracle down in this range? And I just want to explain that Oracle, it's getting to levels where actually it's really attractive down below, let's say 190 down to 177 as a swing trade, as even a longer term investment. But again, there's a lot of other players that have big issues here. Okay, let's flip back to the S&P, folks, quickly. So what we have here, folks, on the S&P, we're still monitoring this bigger parallel channel. And again, even with yesterday's up move, we aren't even close to getting back to that level. But again, it does limit the upside. One thing we talked about in yesterday's My Trading Game Plan is that, if you're bullish into year end, that's fine. And we could get a Santa Claus rally. But again, the upside is very limited, right? If we go back to this trend line, which you have to respect as it has marked the major high and all the major lows down here for the past 5+ years, you're only looking at about 1.33% gain per yesterday's close. Now, again, with today's gap down, if it were to rally back up, then it's maybe about 1.5% or 1.6. But still, again, 2% even, that's not a lot of reward for the risk that you take on when you could have a bigger drop. Even a drop back here is 5% just to the lows we saw a few weeks ago. All right. So again, risk reward, we have to look at that as traders, and also this trend line up here. And really, again, while there'll be stopping points, what have we seen? The last time we hit this level, eventually we zigzagged, but eventually we came all the way back down here. And you got to wonder, maybe we go up there and then get rejected, but then does it eventually wind its way down to that lower level on the charts? All right, guys. So again, just keep that in mind. The Qs are down in the morning session, of course, on the back of Oracle, on the back of worries about the Fed. And I do want to be clear on this. I mean, Oracle's earnings and the drop on that stock is significant, but don't think that's the only reason why the markets are going lower. If you remember yesterday, we talked about how when the Fed comes out, the markets, and this is from yesterday, when yesterday's My Trading Game Plan, we said, okay, the market knows we're getting a 25 basis point cut. We got that. Then we said, okay, well, the market is expecting a very hawkish commentary. I said, if it's a little bit less hawkish, markets will rally up. If it's much more, or I should say, if it's a little more dovish, markets will rally. If it's very dovish, markets, the initial reaction will be like, yay, this is great. But then they're going to say, wait a minute, why is the Fed so dovish? And in this case, why are they doing quantitative easing all of a sudden? What do we not know? What's going on in the repo market? You have credit card late or defaults that are now at levels not seen since 2011. I mean, there's a lot of this data, And the question is, are they starting to think it's going to turn into something bigger, like a debt bomb, like we've just discussed? And that's where I think you're seeing this reversion to the downside. And in the overnight, it wasn't just Oracle. It was a combination of the Fed introducing quantitative easing again. All right, so let's continue on here. The 10-year yield. Now, what's amazing about the 10-year yield, guys, is yesterday in my trading game plan, we talked about how the 10-year yield almost insinuated, based on the chart, mind you. So the chart was actually guiding us that the Fed would be more dovish. And look at this. This is what I love about charts, of how they can kind of predict this stuff. Look at how major support, major support, major support, and then we broke down major resistance, resistance through here, and then right into the Fed decision. We were trading right up here. Then yesterday on the Fed decision. And again, what do you expect from resistance? Up into resistance, it should get rejected. And the Fed, by being more dovish, obviously rates pulled back a little bit on the back of them being more dovish. So in fact, amazingly, the chart was able to guide us to actually thinking, okay, the Fed could be a little bit more dovish. And in my opinion, they were very dovish. The dollar, look at this, guys. Yesterday in my trading game plan right here, we talked about how the dollar had a bear flag. If the Fed is more dovish, it means they're likely to put more money in the system, print more money, right? Or make liquidity greater, which then weakens the dollar. And look at yesterday. Going into yesterday, we had this down move on the daily chart. Then we had this inside bar bear flag. It told us the dollar favored. And listen, there's no 100%. So, I mean, listen, the dollar could have gone up. It was just odds favored a drop in the dollar, which then again did occur. Because again, you listen, the idea is, as a technical analyst, you are basically looking at the chart and saying, what's the most likely outcome? Not what's guaranteed, because there's no such thing, but what's the most likely outcome? And ultimately on the dollar, it was a weaker dollar. And that's exactly what we saw. Incredible how these charts can really help us understand an outcome of a Fed decision like that. Isn't that wild? All right. So we've looked at Oracle. I want to now go to Netflix. Now, Netflix is getting a small bounce today, but this is getting in a territory where I'm going to start to look to pick it up. All right. So now, things I'm watching here. So number one, I want to focus on some levels here. There's a good level right coming up here at a break of $90. If Netflix breaks $90 today, I may look to go long. Notice pivot low here from 2019, pivot low from 2020. That's March of 2020, the COVID low. We then broke below. We came back. We established back above. We hit it right here. We bounced up. This should be support basically below 90. Now, is this a long-term level for me or just a swing trade? The answer is it's just a swing trade. I don't trust this market more than I can throw it, and that certainly isn't far, folks. In other words, I do believe that there is a house of cards. I think we all agree there's a house of cards. The thing that we may disagree on, that I'm still even figuring out, is when does the house of cards collapse, right? Is there enough levers from the Fed like QE to keep the market floating up for, let's say, months or even another year or two? Do we get to the point where we start getting into 2029, which would be a 100-year cycle from when the stock market collapsed and we got into the Great Depression? I mean, these are all things that I'm constantly looking at the charts, and inevitably, generally because we are positive as human. Remember, if you're negative and you're depressed, what do? They medicate you to be positive. So that's why investors are always looking to go long, right? We generally inherently believe that things will go up. At the same time, that's a great attitude to have. It can also be a failure when things finally collapse, right? Because then we get caught holding the bag. All right, so let's go back here. I will be keeping an eye on the break of 190 today on the Netflix chart. Now, just checking out this chart. This is your semiconductor SMH. All right, this is your weekly chart with your 200 weekly moving average. Now, the reason I'm revisiting this is because we have to look. We've now come up to a double top on the SMH. And so the question is the SMH, could the SMH still go higher? Now, the answer is yes, it can. And I'm going to show you why. Now, it's not, listen, there's not a lot of upside. But the idea is that what we've seen historically in 2021, we got 102% above our weekly 200 moving average, and then we dropped 45%. Here in 2024, we got 102% above, we dropped 40%. Now here, we got 102% above, we pulled back sharply. Now we're back to the highs. But look, the 200 moving average is up slightly. Now, listen, we may not break double top here today. For instance, semiconductors are going to open down. We'll have to watch Broadcom earnings after the bell. But if we look at what 102% is from here, from the current level of the 200 moving average on the weekly, it brings us up to about 385, which is just a little bit higher. It's about $15 higher or so than where we currently are. So again, what I would say is there's minimal upside, just like we talked about on the S&P 500. There's minimal upside in the S&P. Same thing with the SMH. It's possible we could go and make a new high here. But again, you'd have to assume that this extension of 102% away caps the upside on the SMH. Now, you can't go to 105 or 110 or 120. And the answer is it can, but when we're data-driven investors, we look at history as our guide. And when you see literally every time in the past 10 years, the most we've ever gotten away from the 200 moving average is 102%, we have to go with that until proven otherwise. And I use that term until proven otherwise all the time because we can be proven otherwise, right? It's just that's our data set. So if we're data-driven, logic-based traders and investors, we must go with that until it's proven otherwise. Otherwise, we're just going with emotion, right? And emotion, honestly, out very well in my trading and investing career. All right, Nvidia, guys. Nvidia was down yesterday, even with the market up. It is down again today. I talked about this as a bear flag. It certainly looks like that's beginning to play out. AVGO. Earnings today, this is your intraday, so it's basically flat to slightly lower. This is actually where it closed yesterday, so it's actually down decently, about $5 pre-market. They report earnings after the bell. Here's a trend line that we tagged yesterday. I think this goes down on earnings. Granted, I thought Oracle was going to bounce on earnings, so maybe I'm going to be wrong as a possibility. I also think there's always a possibility of an initial pop on earnings, but then the next day a fade. So that, just keep that in mind. Is their earnings are going to be spectacular. They are. But number one, most of it's factored into the charts. And number two, what we've seen through a lot of these earnings is the stock will gap up the next day and institutions will dump like crazy. And the stock sometimes goes negative like we saw in Oracle, right? Oracle had that great day on earnings last quarter, and then it just went down, 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 down. The key here is the technical trend line. This trend line is something to monitor. So let's watch. This will be a huge report, guys, in the after hours today because this is about a $2 trillion company in the AI space. Okay. Costco reports after hours today. This stock has been fading quite a bit. It is at support. I am not going long on Costco. I'm not short either. But again, see this trend line right here? Watch this trend line. Do we break it? Basically, do we break 870 to the downside? If we do, you're likely coming down to about 790 or so. If it can hold, it can bounce, right? But again, Costco reports earnings after the bell. And Lululemon, we'll look at Lululemon in 1 second. But I just want to point this out, is we have a new show that debuts at 3:55 p.m., and then it goes right into Trading the Close with Drew, where he summarizes and goes over the charts at the end of the day. And these are all free, by the way. Just like the game plan here, it's free. But Lawton literally knocks it out of the park. Yesterday, he nailed the high on Adobe's earnings for a short in that, and holy cow. In fact, let's go to that chart now. Let's talk about this, folks. Take a look at this. Look at Adobe yesterday. So Adobe yesterday, he gave out his level right up here yesterday. And he said, all right, guys, if it pops into this level, this is a short. And look at that. It goes to 360, 361 and drops all the way down to 340 here or 339. Incredible. Listen, just like any trader, he's not going to be 100%. I'm not 100%. We're just looking at charts that give us probabilities, but it's a free show, his earnings show. Anytime there's big earnings, he's going, and he'll be live today at 3:55. It'll go right into Drew's Trading the Close later, all free on YouTube or on our homepage. Okay, let's continue on. Lululemon reports after the bell today. If you look at Lulu, it's tricky. So for me, it hit support already right down here. Like, look at this beautiful level of support. Going back to 2018, but it's also already bounced. Now, again, this is one of those things where if it dips, you probably have a lot of support around 162. Maybe it favors a upside move. If it does rally, I think this 225 level would be a likely upside target. Again, I'm not long, I'm not short. I'm not planning to go long or short into earnings. But again, Lawton will be covering this, Costco, and Broadcom in his earnings show later today. All right, Bitcoin. Listen, yesterday I told my members, I said, guys, Bitcoin did not hold its gains when the stock market rallied on the Fed yesterday. Initially, Bitcoin popped and then it fell back in. I said that's a leading indicator. Bitcoin has now become a staple indicator for the stock market. If it doesn't hold its gains and the markets rally on news, I say markets probably are going down the next day. That is happening. Now, in that same vibe, we're still stuck on Bitcoin inside of this upward bear flag formation. So it's doing exactly what I talked about it doing for a long time. I remain long on Bitcoin. We're basically flat on this position, give or take. I still think it can maybe curl up into year end up to about 100,000, but then ultimately I still think it's going lower on the charts. Gold here. Here's our wedge. Here's our breakout, our bull flag. Look at how gold is hugging this upsloping trend line. So the bear flag's trying to play out. The only issue I have with this is bull flags. And I apologize, I said bear flags, but this is a bull flag, right? Bull flag. But bull flag should have a more explosive move to the upside. It's a little concerning. Gold is having so much trouble. Maybe it starts to catch a bid today and has a bigger push, but that is a little bit concerning. It still is bullish, though, until proven otherwise. This level down here, basically at this point, you would need to take this out. If we took out 4,100, then I think you have to flip your bias towards downside. But until then, you go with the upside probability. Silver. Look at the momentum on silver here, folks. It's even above my parallel. I still think it actually could sell off today and go negative, so be careful on this. This is really extended, but you have to give silver credit, guys. It has been resilient beyond belief. It's been a momentum trade, but again, like most momentum trades, it can be fickle, and when it starts to dive, it can have a big correction. Remember over here, it topped out, and look at that fall. Now, granted, it went to a new all-time high, but don't be surprised if it retraces back into this 54 level before its next big move up. Oil down again today. Did have a bounce yesterday. It's still hugging this zone. Again, just hovering inside of this parallel. Tried to break out, failed. And then natural gas, guys. Look at this. I am looking to go long on nat gas. This is a good retrace level on natural gas, guys. So again, long on nat gas just for a quick trade off this Pierce of 420 here. Look at that pullback on natural gas. I gave you guys the top on this as a bigger pullback zone. Now I'm actually saying I like it as a quick bounce, maybe back to 450, 440 on a play here for a quick trade. All right, guys, I got to get to my trading room. We're looking at some good action today in the live trading room. You can find that at verifiedinvesting.com, where we'll be giving out our actual trades in the market, our exact entries, our exact exits. We give you a heads up so you know what trades are coming. Basically, you get to follow us if you so choose. It's there for you, the Apex Live Day Trading Room. Have a great one, guys. I'll talk to you soon. Take care.